Netcare operates the largest private hospital network in South Africa and the United Kingdom. It was founded in 1994 and acquired Clinic Holdings, Excel Medical Holdings and Medicross. It has a market cap of 25 billion rand, a price to earnings ratio of 18 and a dividend yield of 3.3%. You were saying off air something funny about Netcare?
Yeah, look, it's an interesting story too, because similarly started out as a network of privately owned facilities, then they started aggregating them. You'll remember Marty Sachs and then Jackie Shevel were the two kind of emerging CEOs that drove the group. They bought Clinic Holdings, which was actually listed, quite a big group. So everything was going brilliantly. Then they got the young, good-looking, telegenic CEO, Richard Friedland, and there was no stopping them. Then somewhere around, 5 years ago, they decided that South Africa was getting too small for such a premier group. They must go to the UK. They put down big bucks, like 20 billion rand, to buy General Health Group, and they bought not only the hospitals but the buildings as well. And their thought was, look, we don't really like buildings, we'll sell them to someone else. Well, anyway, we know what happened next. The private healthcare thing kind of went into lockdown because of the UK recession. Still getting lots of work, you've got the national healthcare system there and they get the extras. But unfortunately, they've been sort of left stranded now with all these buildings and a huge debt facility, non-recourse to South Africa, but it's currently tottering. It has to be restructured in 2013.
Just looking at the share price performance, Gary, talk us through what's happening on that front.
I think the share price started slumping a little bit, as Paul was mentioning with the debt. They had to write down all their goodwill in their last results, and I think that really just shocked the market a little bit into thinking, wait a minute, something is going to happen here. I mean, the rumours starting to fly around because their property company, their UK hospital business and their South African business, they're all ring-fenced. So you can't, even if they defaulted on the property, which they owe probably, I think it's about 1.5 billion pounds, and the property is only worth about 1.1. So financially, they could default on the property, so scrap that. They've already put in place 20-year leases with their hospital group in the UK, carry on running the hospital business, and just write it off. And that's while financially it would be great, it would be a huge reputational risk to the company. But I think the uncertainty around how it's going to happen. I mean, it's all going to happen before October next year, when they have to roll over the debt. The company's official stance is that they will just roll over the debt. It's not going to be a problem. But I think market uncertainty bringing the share price down.
Richard Friedland has been at the helm for quite some time now. Is he the right man to sort out?
No, he's a top guy, very smart, got all the business skills, has all the medical understanding as well, understands where the business is going. So I don't have a problem with that. They've got a fantastic network of hospitals here, fantastic relationships with medical specialists who operate from their hospitals and so on. And as I said earlier, top class globally. You know why? When politicians in Africa get sick, they don't stay in their own feeble hospitals. They get on an airplane and fly to South Africa. But leaving that aside, this thing with the debt, what you must understand here, what Gary is saying is that there are these buildings, right, worth like 1.5 billion pounds. That's a lot of money. But the properties themselves are the collateral that the funders, the banks and others that lent them the money. So what they could in theory do is say, listen boys, this thing looks bad, but it's your problem. And that wouldn't necessarily affect the company that we're investing in.
Which is why you're saying it's ring-fenced in the UK.
But the sort of reputational issues, the fallout that would be associated with a thing of this nature, because you know what it's like. It's like saying, well, I'm going to walk away from my mortgage because my house is underwater. That's fine, but at some point you shouldn't expect to get a positive view if you next want to go and borrow some money from the same people.
How big can the fallout be?
It can be pretty large, but like I say, financially.
From a reputational damage perspective.
From a reputational damage, I don't think that it's going to happen. I mean, those are the rumors sort of floating around.
Would that cause a collapse in the share price?
No, I think it'll probably cause a spike in the share price because they'll have all their toxic debt off their books. Thanks to look at it this way though. It's not their fault that they're in this mess really. I mean, they bought into a property. Their plan was to go there, buy the hospitals and the property, and then flip the property off immediately. It just so happened they did it in 2007, and in 2008 the property market fell apart. So I mean, you can't.
Hindsight's a perfect science.
You can't exactly blame them. It was a once in 100-year sort of crash. So I mean, I think it was a great move to go in there. But at this stage, they are sitting with a debt problem there. And I mean, the company's official stance is that they will roll over the debt and it won't be a problem.
But it doesn't sound as though the market believes the company's official stance.
Well, it's interesting though, because when this started to break, and as this deadline gets closer, and as they took the decision to reorganize their financials and deconsolidate the results of the property company, all but complicated, the share price hasn't fallen down by such a lot. And I think the reason is in what Gary was saying, is that this is not a company that is regularly in the business of doing property development. So the idea that they could tell the banks to get stuff doesn't really matter so much, because they don't normally have to do that. It would have been much harder, for example, Redefine International had a similar scenario, but Redefine, being a property group, has to have long-term relationships with funders all the time. So I think this may be an opportunity, but my general sense is this uncertainty keeps this one a little bit on the back foot for the foreseeable future.
Hot or not on Netcare, Gary?
Yeah, even with the share price, though, we're looking at for a short-term trade on a technical basis, 117, or at least 17.10 we're buying it. But yeah, I still think the company's hot. I think even with the uncertainty and the risk, it's a more of a punt, but yeah, definitely hot.
Paul, hot or not on Netcare?
I'd like to say not for now, but I think we've got to watch it closely, because I think a resolution of all this complicated stuff we've been talking about could be a positive catalyst.